right, welcome to another episode of Vyzer Visionaries. I'm your host, Litan Yahav, and today we're going to talk about investing in billion-dollar private equity firms with the one and only Ivan Barratt. Welcome, man. How's it going?
It's going good. It's exciting to be here. I've been waiting a while for this one. It's finally happening, and it's a pleasure to be here with you, Litan.
Yeah, well, thanks for joining us today. Before diving into this super interesting topic, give us a quick background about yourself.
Sure. So let's see here. It's 2024. I've been at real estate now for about 24 years since graduating business school with a fancy, shiny degree in real estate. Worked for someone else for several years, and then in and through the GFC, learned a lot of hard lessons. And in 2010, I hung out a shingle and started a property management company. Back then, we called it Barratt Asset Management. Today, it's just BAM. And we grew that into a successful company, used that to bridge into real estate syndication, doing one deal at a time. And then several years into that, when we had a long enough and good enough track record, we moved to the fund model. And so now our private equity real estate platform, done about $1.5 billion in transactions, currently managing almost $1.3 billion in assets. And gosh, started off real small and just continued to grow it. Inc. 5,000 company now for almost I think the 7th time this year. Got almost 170 employees here at BAM. And our goal is to democratize real estate for individual high net worth families and investors so that they have access to institutional multifamily strategies. Now we're very concentrated in multifamily, pretty niche, I'll say an inch wide and a mile deep, and different strategies within that sector. But it's just having a lot of fun still, man, growing this thing and seeing how far we can take it.
I want to back up. So you started with a property management company, yep, and which evolved over the years into this massive private equity firm with a fund that invests in multifamily assets, right? So that transition...
on Fund 5 now, yeah.
Yeah, that's crazy. All right, so when you were doing property management, were you even aware of syndications?
Actually, yeah. The goal was to become a large private equity platform just through observation of the markets, successful participants, a lot of unsuccessful participants through the GFC. I quickly realized that we'd have to get the management piece of it down, the execution piece first. And so that was my bridge to eventually be able to do larger deals with pools of investors. But first felt that I needed to build back track record from a small point. And that ended up being a huge advantage because I got to learn all these mistakes and really figure out how to grow a company at a small scale first so that we would learn from those mistakes before we got big, where the mistakes can really damage you. So it was good to fail small, fail fast, and grow from there.
What you're saying is that you started a property management company with a vision to sort of build it from the ground up. So you wanted to have that department already under your belt so that when you start this PE firm, you'd already have that, you'd already be vertically integrated, basically.
Exactly. I saw some of these long-standing firms that were born in the property management side of it first. And so I had this inkling that if I could figure out the execution of the actual management of the projects, then I would be a lot better equipped to take on investor capital and do larger deals. I mean, we're seeing it now, right? Anyone can go out and buy great real estate, but it's really the rubber meeting the road after you close on that asset. And the reason why returns can be so great in multifamily is because it's actually the hardest asset class to manage on the face of the planet. And so I thought it would be incredibly difficult and hard to start the management company first and grow it from there. But for me, it seemed like the only route to take if I wanted to be successful long term.
But isn't asset management a totally different ballgame than property management? It's like it's different. Property management is like operations 100%. Asset management is like, finance and business plans and investor money and, the legal aspects of it. That's like a totally different ballgame, isn't it?
You're hitting on a great point. It's a good question. I would also argue or push back a little bit that asset management also involves managing the managers at those communities. So today, I think we've got 24, 25 communities now, and most of those are a couple hundred units or more with an on-site team that's there every day. Well, it's not just so easy that you can say, hey, property manager, maintenance supervisor, here's your budget. We'll see you next quarter. Let us know how it goes. Part of the asset management job description is overseeing those budgets, the capital expenditures. When should we be replacing roofs, for example, and overseeing the day-to-day operations from almost like an executive level perspective. In addition to investor relations, which really oversees the equity finance and management and stewardship of the investor capital.
All right, so you switched over from a private property management company to your first like syndicated deals, right? And then like what were the biggest challenges, the top 3 challenges moving from an operational company to I'd say also operations, but then it goes also like to more building a business of investor money and deal pitching and, all that type of stuff.
Well, there we're in agreement. The property side of it, the asset management side, it's its own business. That business is still here today. It's really the biggest ingredient to our secret sauce, if you will, is the execution of that management company. They're the ones responsible for being the boots on the ground and the day-to-day execution. I have this conversation a lot with sponsors that are looking to grow their investor base of retail investors. And you are absolutely correct. It is a whole nother business. We could spend 3 hours talking about the challenges of that business for sure. Growing a customer service, investor customer service department that can service and manage and take care of those clients to the standards that I could do it. So in the beginning, it was me and an admin on the investor relations side. I was the investor relations guy. I was the one pitching our deals, answering investor questions, follow-ups, that sort of thing. Growing that into a business is challenging, just like growing any other business. You've got to have the right people, the right systems. There's no straight line, right? You're going to get hit in the mouth. You're going to make mistakes. Responding to those mistakes, continually improving. One thing I would say that was really beneficial is I had some great investors early on that would drive my team bonkers. We would get an email from a guy, right? It'd be 10 paragraphs long, filled with questions, and the team would be, oh my gosh, Ivan, like Jimmy wrote us another email, and we're going to have to drop everything we're doing and spending time on this. I'd say, hold on, take a step back. Jimmy's email is tens of thousands of dollars in free consulting on how we can improve our business. Let's look at it that way versus, we've got to deal with this investor that's got more questions than the average bear.
The early days, or even today, would you prefer an LP investor that's a pure LP investor that has never done active real estate? It's just like a doctor or whatever, someone, just a high net worth individual that wrote a $200,000 check, or a GP that's done thousands of doors and they have their own operating company and they invest with you as an LP. What do you prefer?
We get very few of the latter. Most GPs out there that are operators that say they're looking at me to invest passively, 9 times out of 10, they just want to look behind the curtain and see how we're doing what we're doing. Unless they're using qualified accounts, which we get a lot of. A GP can't take his SDRIA, his self-directed retirement account, and invest in his own projects, might be investing in mine. Or we've gotten a lot of, I would say, sort of lower to middle market real estate investors that are tired of being an active operator, and they're looking to take that portfolio and roll it up into more passive assets where they can still benefit from capital appreciation and cash flow, but they can get a lot of their bandwidth back and put that towards travel, grandkids, or any other passions they'd rather pursue than being a landlord on the weekends.
So when you were at that phase, or maybe even now, and I'm going to circle back to this question because I want to dive deeper into it. But have you invested as an LP with other GPs before building your own operation?
No. I've done a couple of LP investments outside of my own sector, but I've really put that on pause and just concentrated mostly on my own assets. So when I was growing the business, Litan, I didn't have any money to put anywhere else. The reason why we've been successful in this amount of time is my partner and I believed heavily in reinvesting in the operation versus just extracting all the capital and handing it off to someone else to invest. For me, I'd rather bet on myself and my team and the returns that we can achieve versus investing with other syndicators, other GPs.
Okay, so you went from the property management, you founded the first syndications, you've raised initial capital from investors, you started to grow your team, and then today, all right, you're at a huge team. You have you've surpassed $1 billion of assets under management. You have 24 communities. What's like the biggest, the top two differences from a multi-100 million operation versus, all right, you now have multiple funds, your fifth fund, more than $1 billion under management. Like, what's the biggest difference from a GP perspective? And then I'm going to flip it over to, like, as an LP, all these questions I have, the different phases of that, how that affects us.
Sure. Yeah, I think I know what you're asking. The difference between running a company that's got a few hundred million in assets versus north of $1 billion. It takes a lot more people. It takes a lot more expertise at this point. Smaller company, people wearing multiple different hats, right? And as you grow, there becomes a need for more specialization where we've got an expert who's really good at, say, private equity accounting or fund management. We just hired our third attorney this quarter.
Like, all right, have your investor personas changed? Are you looking at different types of people? Because I mean, if you're at that point raising larger capital, you're not going to raise $50,000 checks anymore.
All the time. I've got over 1,200 investors. We get tons of $50K checks. Now, some of our offerings, like the fund offering, is a higher minimum than that. We have some one-off JV opportunities where people can get exposure to development, so they're still writing $50K checks there. The fund is a $200,000 minimum. Every now and then we'll let in friends and family, somebody that we really like, for a little bit less than that. But we haven't gone to institutional. I don't play with joint venture equity guys that want to basically work me like a puppet. No, I'm scaling a business that is tailored to individual high net worth families and stewarding their capital in the real estate space. So from that standpoint, nothing's really changed. Interesting.
All right, so that's interesting. I think that's also unique because,
probably
GPs that grow to a certain level at some point aspire to not, because it's a freaking headache, right? To deal with so many, retail investors, small checks. It's hard, I assume. And then I'm saying you have those people writing you long emails like, why are you doing this? Why do you do that? How many do this?
Yeah.
Whereas an institutional investor writes a $100 million check and you're good to go. Well, they probably might be more in the weeds because they have a big position. They get they want maybe part of the GP, whatever it is. The trade-off that's involved with that.
Yeah.
When you reach $10 billion in assets under management, are you thinking still taking $50,000 to $200,000 check minimums depending on the deals?
I would think at that time we will still have products available for those investors. Absolutely. If I wanted to go the institutional route, I would have done that a long time ago. There's pros and cons to both, but I am in no way, shape, or form looking to kick out all my loyal investors that brought me here and got me here and just start doing institutional deals only. So, if you look behind the scenes on those institutional allocators, a lot of the capital they're putting together, man, are from individual investors that they're aggregating. I've taken out that middleman. And yeah, it might sound easy. Oh, now that I've got a track record and lots of AUM, I just go out and get the $100 million check. But there's a lot of other strings that are attached to that check than there are working with hundreds and thousands of retail investors.
Right. That makes a lot of sense. I guess there's always that trade-off. All right, so let's go back to the difference between these a big fund, because one of the things that I've always had this idea of is that and I think we spoke about this in one of our calls before, but I used to prefer to invest with smaller operators. Different reasons for that, but one of the reasons is because these operators are going to go and find, one deal. They don't have big operations, and so there's not a lot of overhead, so the fees are usually not that high. And they're going to go and find the deals that have a lot of meat on the bone and bring them to a few, like 10, 20, 30 investors. And then it's like a smaller type of syndication, right? Usually the terms are good and all that, and that's like what I've looked at. But then as I grew at the beginning and invested in more and more deals, I've seen that there are different types of larger firms, and not all of the big firms have really high fees, and not all the big firms have really strict waterfall structures. Would you say that the more
experience, strict waterfall structures?
Well, more or less LP friendly waterfall structures. Like if I go to like a smaller operator, okay, the pref. Let's talk about single deals, all right? But also, I guess, funds might be different. The pref. There's either there's a pref. It's usually pretty high, and then above the pref, there's a waterfall that can be, well, let's just say, 8-9% is a high pref. I think.
Is it?
I don't know. You tell me. Is it?
It depends on the deal, man. I think the better the underlying security, the longer the track record, asset class, that sort of thing. I think the pref can move. It might be 7% for a highly diversified fund, and it might be 9 to 10% for a more speculative development.
Okay, fair enough. But then above that, there's a split. Let's say 80-20, 70-30, whatever it is.
Okay.
And for the smaller operators, usually that's it. And it's usually more towards the 80-20, 70-30 max.
Okay.
The bigger operators are going to have a hurdle rate, and then above that, there's going to be whatever, 60-40, and then another rate above that, then it's 50-50. Now, those are things you'll see with more experienced operators, the larger ones usually.
Sure.
I'm not saying across the board everyone does that.
Both ways, yeah.
Is that something you think is more common the larger you get and the more experience you have?
It's pretty standard or customary in this business that as you grow and your track record gets better, you tend to get better economics as the sponsor than you would if you're just starting out. So, maybe on fund one, I give up a little bit more economics to some lead investors or a GP participant than I necessarily have to do on fund 4 or 5.
So when you're looking at your the fund 5, all right, what are you targeting IRR returns for investors in that fund?
So fund 4, we're closing out right now. That target is a 15 to 20 IRR, but we're really multiple driven more than IRR driven. So what we're typically looking to do is have a high conviction that we can get double to 2.5 times that investor's capital back to them plus or minus 5 years. Now in the past, we blew that out of the water the last few years. IRRs in the mid-30s, multiples 2.5 times on a 3.5 year hold period. Once we get through this buyer's market that we're in now into more of a maybe what I would call a stabilized market or an even market, I think those hold periods are going to be more like 5 years than they are 3.5. And so the way I would look at it is, okay, let's say it's 2.5x is my target to my investor. If it takes me 7 years to do that, it's like an 18 IRR. If it takes me 5 years, it's a low 20s. And if I could do it in 3.5, it's a mid 30s. And so what we try to do at BAM is educate our investors that if there's an area in your portfolio that you don't mind having illiquidity for a while and you want real estate, and you understand that if 5 years from now it's 2008 2.0, we're not selling, we're going to hold that fund and sell when the market conditions are better, then it's probably a good solution for the portfolio.
Right. First of all, that's an amazing target. 18+% IRR for a fund that size. So much diversification. That's pretty amazing, to be honest.
Thank you. Thank you for noticing.
Especially for a multifamily value add type play, unless you also have development deals within that.
No, it's all value add. It's approached a little bit differently than we used to, but it's all buying existing. We look at it like a business, Litan. Think of it like a private equity roll-up firm. So whether it's HVAC companies or tech companies or whatever, we're looking to roll up businesses where we have a high conviction that bring in our management team and our way of running things, along with a great asset in a market that we see as a growing market. Those sort of three things on the pie chart equals a high conviction and at least a 2x return to our investors on a 5 plus or minus year hold.
And the previous funds that you closed out that are already performing, are you guys meeting those numbers that you guys targeted?
So our track record for the last several years on our first 12 exits was a 35 and change IRR. It was a 2.5x or 2.5 and change equity multiple on an average 3.5 year hold. And that's so far we've returned almost $190 million to investors. On our current funds, some funds are doing better than others. But I think that what really changes in this environment is the hold period. So I have no doubt we will still hit our target multiples of 2 to 2.5x on those assets in our current funds. But I don't think we're going to hit anything on a 3.5 year hold given the environment we're in now. I think those hold periods are going to go closer to 5, and maybe a fund goes to 7. But if it takes me 7 years to return 2.5x to my investors, and that's an 18 IRR, I can sleep very well at night. And if anybody wasn't happy with that, then I would say, feel free to take your marbles and go home.
18% is an amazing return in this environment, 100%. So this fund,
we're not going to sell anything in this environment. Right now, we're
you're buying,
aggressively buying.
Right. Like, what's your target in terms of how many properties or communities are going to be in this fund?
Well, it's more of a how much equity and how much real estate are we going to buy sort of a function these days. So this year we will deploy plus or minus $150 million, and that should buy us right around $500 million in real estate.
So when you define a target of deploying that much capital, doesn't that put you in a position that you have to find deals?
No, we raise the capital and look for assets at the same time. So one thing that can be really hard for operators, sponsors to transition to is going from single assets to a fund, because that's the big question a lot of people are going to ask you is, well, how do I know you're not just going to do deals just to get money out the door and collect fees? And the onus is on the sponsor to enforce or influence or get the point across that that sponsor's greatest asset or my greatest asset's my track record. So if I were to sacrifice my track record by just putting money out into mediocre deals, the growth of that machine gets slowed down and maybe even starts decreasing, turning the other way. So getting that trust that I'm not gonna do those sorts of deals is very difficult to get. It's even easier to lose if you break it. So that's an incredibly important thing in my business, is keeping that trust and keeping that track record.
I think that's a super important point, because one of the things that, again, for big operators that I'm always concerned about is exactly that, right? Because you have huge overhead because of a huge team and a huge investor pool. You both need to provide deal flow for the pool of investors who want to invest. You need to deploy that, and you also need to fund the operation. And so you need to have the fees that goes with raising that fund. And that's a concern. And so I think it's so important. It's so important. It's still like one of those things that's really, important to hear from an operator, a sponsor. For me, by the way, I think an operator is more important than the sponsor. But anyway,
I couldn't agree with you there more.
And
we're seeing a lot of sponsors that aren't operators get vaporized right now.
Yeah, we can go. That's a whole conversation. But yeah, but how do you it's really nice to say, and I believe you when you say it, because you've been in the business for so long. But how do you sort of convince, or you don't need to convince because of the brand that you've built, but how do you convince investors that you're really going to walk that talk where you're only going to call for capital when a good deal comes to the table? You're not going to call it capital because you need to deploy $150 million, right?
Again, going from single assets to like Fund 1, for example, was incredibly difficult. I think I was on the phone with literally every investor in my Rolodex, and many of them in the beginning said, hey, no, I only look at single assets. I don't do funds. And I literally had to get on the phone with all those folks and say, hey, this is why this is good for me. Let's get that out of the way. And here's why it's good for you. And then, what we do is maybe a little bit different than most. Like, it's not completely discretionary. We have a pretty tight buy box that we work in, that we share with our investors. We give them a business plan for every deal that goes into that fund. We call it an asset supplemental, so they can get a flavor of what's going in there. And if I do that well enough, then that investor that maybe wrote a $200K check at the beginning, I've got an opportunity as we put more assets into that fund for them to top up and do more investments. And I was in a position where I had a really great track record with lots of exits on it first. And so I'd already sort of built that trust and rapport with my investors. And that really helped bridge the gap. And again, it goes back to, my single greatest asset is my track record. And if I start effing that up by doing mediocre deals, then this whole thing starts to fall apart. And so if I can convince somebody of that huge incentive that I have, then that can help build the trust on their end.
Yeah, well, I love that. Yeah, because that I guess that transition from a single deal to a fund is something that you've seen a lot of operators do over the past few years when interest rates
start up. I've seen a few successful. I've seen most.
Yeah, no, but it feels like it's been this crazy trend where all these single deal operators have transitioned to funds because it's hard to find deals, and so we need them. So I totally get that. I do think there's a diversification that comes with a fund that I might want to take the higher risk with the potential upside.
I would say the fund actually is a lower risk if it's done right, and that's why we were able to convert a lot of folks into funds, is because the simple question is, hey, Mrs. Investor, would you rather put your $200,000 check on this one 250 unit apartment project, or would you rather have that spread across 1,600 units across 6 different suburban markets in the Midwest, which is what we have right now in our fourth fund. If I can get that point across that we're spreading out your capital over several markets, several projects, it becomes far less risky. That's playing out right now in this high interest rate environment. In some of the funds, some deals are doing better than others. And if you had invested in just that one single deal, you might not see any capital for a long time, but because you've got a diversified fund with several projects in it, it sort of evens it out.
I agree. That's what I meant, because obviously a fund is more diversified, lower risk. Personally,
if it's done right, yeah.
If it's done right, fair enough. But per your example, I prefer to take the risk and invest in those assets that outperform, to offset that one that didn't perform, and take the risk and invest in that single deal, right? I don't know how to choose assets. All I know is I feel like I know how to choose operators, but I don't know how to choose assets.
Well, and that's really the evolution for the LP investor as you look at funds is underwriting the sponsor, betting on the jockey, not the horse, and really doing the due diligence on the management team, the sponsor, their capability, their balance sheet, if things don't go according to plan, that sort of thing, versus trying to underwrite the individual asset, thinking that you're going to be able to pick deals better than the next guy.
Right. Yeah. All right, cool. Listen, this is a super interesting topic. I've learned a lot just from this conversation, and thank you for being patient with me. Anything you want to add to sum up the $1 billion question on why? I mean, obviously, I think I know the answer, but why investing with larger private equity firms, billion under AUM, obviously companies like BAM, is good in this environment.
Yeah, the advantage is only not the disadvantage. I think we kind of covered that, right? So
right.
Yeah, I mean, the advantages are it's hard to get to $1 billion in AUM without having some success. We talked about how it should be less risky if it's executed well. Sponsorship's typically more capitalized if they're operating at that sort of level. The way a lot of us do it, the individual investor has access to higher quality institutional type assets. But again, the disadvantage is you got to sort of set aside your need to underwrite individual deals. And this is sort of a pro and a con. At that level, I tell people this all the time. I try to say it as nicely as I can. We want your capital, but we don't need it. And while some people might view that as a con, I think it's actually more of a pro when you're working with somebody that necessarily doesn't need your $200,000 check to make the deal happen.
Right. Yeah. Well, I mean, that's a sentence we can unpack as well, but I love it. And thank you for those points. This was super interesting. Ivan, thank you so much for sharing your knowledge with us today.
My pleasure, man. Thanks for having me.
Yeah, and for everyone out there, thanks for joining us on your journey to become a better passive investor. Passive being the emphasis on this, for me at least. If you have any questions for Ivan, we'll have his contact info in the show notes below. And until then, keep investing wisely. Thanks for joining us.